Hello traders, Corey Mitchell here with TradeThatSwing.com. I want to look at the cup and handle pattern. It's occurring a lot in the markets right now. We see it in specific times quite often when the major indexes are moving back toward a prior high. The indexes are going to be doing this type of price action, so you'll see this type of price action in a lot of stocks. When you have a decline from a high and then they start working their way back toward the prior highs, you see this type of pattern. And you see this well before the indexes get back to their highs, because the really strong stocks will be doing this potentially months before the major indexes like the S&P 500, the Dow Jones, the NASDAQ 100 get back to their prior highs. So basically, anytime after a decline, you can start looking for this type of pattern because stocks are working their way back up to prior highs. We get a cup, which is this part here, and then we get a handle, which is this part here. So in this video, we're going to look at exactly what to look for, why this is a good pattern, and we can see why this is a good pattern because potentially when we get back toward those prior highs, we get this handle, we get the breakout from the handle, we get a nice move. And we're going to look at how to do the risk reward in terms of where we're going to enter, where we're going to set our stop loss, how we're going to set a target, or if we want to use a trailing stop loss. So we're going to cover all that pretty quick. And there's three types that we're going to look at. Or there are three types, and there's a fourth also, but the fourth is a little bit different because it's more coming out of a bottom. Sometimes you'll see a cup and handle coming out of after the price is really low and it's starting to just kind of make its way back up. That's what I call a technical turnaround. That's a bit different. That's a separate video because we're gonna have to look for it in a different way. But if you did happen to find those ones, that how you trade it's pretty much the same, but how we find them is going to be different. So this one, let's start talking about this. We have this big run up, we have this handle form, and this is what I call pretty much at the cup. This handle forms pretty much right near these highs. We have variations of this pattern where sometimes we'll see the handle form just below the high, and sometimes we'll see it form just above. The price will just rip right through this prior high and then consolidate here. So you could have a handle up here, which is also fine. You could have a handle down here, which is also fine. Or sometimes you'll have all three. You'll have the price run up here, it starts to chop around like it did here, but we're below the prior high. That's a tradable move. We're typically going to target this prior high if that's the pattern. Then we may get another one like we did here. So this could chop around here, shoot up, form another consolidation, shoot up, form another handle above, shoot up. So these are all potentially tradable. You don't typically see all three, but you may see one, two of them. So let's get rid of this. So now for our handle, we're going to look at specific things. Oh, I should also point out that ideally these occur in very strong stocks. So I would start looking for stocks with the highest performance and then looking for these here. And as you can see, this one that's up about 300% in the last few months. It went from 40 cents up to $1.25. This is a TSX stock on the Canadian exchange. We'll look at a couple examples of the US, a couple examples of Canadian stocks, because it's all the same thing. And what we're looking for is, yes, strong momentum, and then we want to look for a contraction in volatility. So we have this move here, a pretty big drop. The next move up, smaller. The next drop, smaller. And it's just, you can see it's tightening up. Then we have one, what looks to me like a final flush out, and then finally a breakout out the top of, I like to look for consolidations in these things. So here we have the price basically moving sideways from this point where it doesn't break above that high. We do break out the bottom, but it quickly reverses. So this right here, 1 cent above this consolidation would be my entry point. And it was in this case. And we had a nice run to the upside. If you didn't get filled there, we did have this little reversal which would have filled an order that was sitting there. And then we had this big run up. So that's one thing we look for, is this contracting volatility. I also like to look for contracting volume, typically right before a breakout. Not all the time, but a lot of the time, and on these really good patterns, you're going to have volume drop to almost nothing because people are just forgetting about it. They're watching this run up, but now it's just been chopping sideways. They're losing interest, which is the exact time you want to start looking at it. And we can see volume really low throughout this pattern. It picks up a little bit and then just starts to fizzle off again. And right at this point, we had probably one of the lowest volume days during the pattern right there. You can see like barely any volume. Then we have a false breakout down the downside and then the pop higher. And you can see I've set an entry right there. These are going to be, I use buy stop limit orders. So there's a couple things going on there. You have a buy stop limit order. The limit order triggers you into the trade, the stop order triggers you into the buy trade when it moves above a certain price. This price starts consolidating. The high is 94 cents. So you can put a buy stop at 95 cents. So if it moves above this consolidation, you want to get triggered in. But I also put a limit on it so that I don't pay more than, let's say, 96 or 97 cents. Because I don't want to end up, if this gaps up, I don't want to end up buying the stock up here. I want to be able to make that. If I decide to do that later, that's my opinion, but that's not this strategy. We want to try to catch the breakout point. So we're going to use a buy stop limit order, put out the buy stop just above the consolidation we're looking at, and then cap it. How much are you willing to pay? It's usually only, maybe I'll pay an extra % or so, and that's about it. As for, you can see the risk reward here. As a most simple rule, I use 3 to 1. So if your entry is here and you put your stop loss below a couple swing lows, the last 2 bars here, this was a false breakout. Then we chopped around and then moved up. I feel that's a pretty good stop loss. I don't feel it needs to go down here because the market already came down to test this level. So I think below these 2 little swing lows is good. So with commissions, you're probably risking about 10%. And so you want to look for at least 3 to 1, so an upside of 30%. You want to look at the price movement. Is 30% realistic? In this case, I think it is. The price is running quite aggressively. And this one hit the target within about a couple weeks. So that's the basic idea of the pattern. We're looking for contracting volatility. And let's look at a few other ones. So another one here, consolidates right near the prior high. There wasn't not too many handles forming here. You maybe could have viewed this as one, but it's pretty low down here. But we do get the contraction. We get a very light trading volume in this area here, and then we have a nice breakout. This one would have been hard to catch because look at that gap. There's a pretty big gap there between the consolidation, and then the next price bar. It never comes back to retest, so you would have had to decide, am I going to buy this or not? So a lot of times if there's a big gap coming out of one of these things, I don't end up in the trade. Here, this one did give me an opportunity to get in. We have this contraction in volatility, several days, a couple weeks of just the price narrowing in range. Eventually, we drop down. We have a couple sideways bars. Volume's fairly low compared to what it was on the run-up. And then we have this big thing, and I put the stop loss here. Entry is just above this consolidation. Again, buy stop limit order just above, and we want to look for about 3 to 1 at least. This one was a nice one because if you had your order here, you would have got filled on the next open right there. So you would have got a little extra 3% or so. So that's exactly how I traded that one, had a 3 to 1. There are times I do use bigger than 3 to 1 if I do think there's more potential, or if it's a very tight consolidation, maybe like 5%, but the stock's been running like 40-50%, then you could have a 10 to 1 trade. Let's go back to TXP for a minute. So again, this is a little bit more drawn out, but you can still see the cup here. We have 2 potential triggers there. This one, unfortunately, we wouldn't have been able to get in unless you used a really big limit on your entry. But you can see the cup, the handle, nice pattern. Okay, yes, ITR. This was one I used a bit bigger target on, simply because it was moving well. And again, you can see the cup and handle. This one more of a V shape. I'm totally fine with that. Really, the sharper it moves back up, the better for me, because that shows that it's moving strongly. A slight contraction, more moving sideways in here. So there we have a bigger consolidation. I actually got in, this started moving sideways right there for just a couple bars, and I actually got in here. Before this big, I didn't know that massive move was coming, but we did see what that kind of tip off was. We had pretty high volume in here, and then it just died right here on these price bars. Then it really picks up on this little green bar here, on this little breakout of the last 2 days, and so I opted to get in on that day. And yes, we had the clues already, the contracting volatility, the contracting volume. So this was a good trade to get into. If you hadn't got in there, you may have been able to get in if you had a limit order sitting out here. Remember, if you don't get filled on the stop portion, the price just keeps moving up. That order will sit out there as a limit order. So if you had set one out here just above this prior consolidation, you probably would have got filled on this little quick drop and then quick rally. This is not a high volume stock though, so whether you got filled on your entire order, that's another thing. But the concept is the same for all these patterns. And again, this was one I chose a bit bigger reward to risk on, because I think I was only risking about that much. I don't remember exactly, but we got out up here right about there. So about a 5 to 1, still about a 35% target. And this one did keep running, but I'm not too concerned about that, because as soon as you're out, you can take your money and find another one where you're going to make some money. So I'm not too concerned about trying to catch like a 200% move or something. Just collect your money and get out. The nice thing is that by doing this, the strong stocks are typically going to hit your targets fairly quickly. Then if we do have a reversal in the market, likely you're not going to be in as many trades, because you'll have cash from the trades you got out of, and then you're waiting for new setups. As the market weakens, these aren't going to break out. They're going to start breaking to the downside. So you're not going to get triggered into new trades. Go back to our list that I had to look at. Oh yeah, Nvidia. This one I had used for a position sizing. You can read that article on tradethatswing.com. So here we have an example of a very small handle. We had a contraction here, but then the price moves up, and then we have this small handle form here. These are a little tougher to trade. Still good though, but you only want to trade them in like very high momentum stocks with a lot of interest in them, because what happens if you start trading these and viewing this as a handle where you just have these like tiny movements. This one was a little bit different because it had already contracted and then it basically consolidated just above. So you could have viewed this as one pattern with a little bit of a breakout already to the upside. But yeah, these are tougher to trade. There was also one down here at the big drop, move up, really stalls out here. Again, probably would have had to get filled on one of these little pullbacks here. But we had a potential little one here. Not as nicely formed as the other ones. Here is what we would consider an above the handle, this one up here. So we can see that price getting squeezed in there and eventually forms this nice consolidation. This would have also been viable. We've had one or two up movements where the price contracts. So these breakouts here, this breakout here, I like waiting for those consolidations. Again, if you have a really hard push down where it tries to, what I call flush everyone out, where scare them out, you can put your stop loss typically below the prior candles or the candles that follow. So on this one, risking about 6%. So at 3 to 1, you'd only be looking for about 18% upside. Easily hit a little bit later. As you start moving further away from the highs, these are still tradable, but we've already had 3 breakouts, so it's starting to get a little less. In my opinion, I'd rather focus on the ones that have only had like one major breakout, as it just continues to keep going. Sometimes you'll be able to ride it 5 or 6 times, but a lot of times they'll start to fail after 3 or 4 major breakouts. But here again, pretty small risks. You're looking for about 15% upside. Right about there would give us our 3 to 1. And that one did hit. If you bought this one, you'd still be sitting in that trade most likely, and would have had to hold through all this junk here. Kinross, another example. We have a couple in here where the price does not really form a major handle. You could view these as handles, but I'm going to show you an example after why this can be dangerous. So in really strong markets, like we could see gold was moving really well. We're basically just shooting up. So in those conditions, you can trade these, but I would say starting out, these would be like more advanced trades. Once, if you're just starting out with these patterns, I would really look for those kind of perfect ones that we looked for at the beginning. Here again, very small consolidation. Here we have a mini cup and handle. We formed a high, pulled back. And a lot of times with these, you won't get the volume confirmation like we did with the other ones. Here, volume's just kind of erratic. It's not really dying off because there's been no opportunity for the price to slow down. So we really want to focus on like these ones that we talked about first. This type of pattern, TXP, BLDP, ITR. And I'll show you why. As soon as you start trading very tiny handles, what can happen is you start looking at trades like this, where you can run into these types of risks, where it breaks out but then quickly fails. Or you can just get chopped up as the handle forms. So you could have looked at maybe this as a little consolidation here. Price breaks out, you're stopped out. You look at this as a consolidation here. Price moves just above right there, then stops you out. And at this point, we haven't really seen any volume confirmation, but now as this progresses, we're starting to see it. And here we have a bit of escalation. So what we'd want to see is this price bounce back up, maybe consolidate in here on low volume. Then this is starting to look like a really good trade. Until that handle kind of matures a bit more, we don't have as much confirmation. Yes, there is a chance that it could just shoot out of one of these like it did here or here, but we're not going to really be able to see that contracting volume and volatility. So it's up to you how you want to trade these. If you want to take loads, you can look for tiny handles, but you're going to get stopped out a lot. It's going to be a rougher road, but you're also going to catch maybe some big winners every once in a while. If you wait for these, I think you're going to see much more consistent results. These types where you're actually seeing the price contract a little bit, squeeze in. What you also want to look for is if you throw in a log chart, this puts everything kind of in equal terms in terms of price moves. So 100% move down here is equal to 100% move up at these prices. And you want to look to see that you're not in a massive, that the handles are still kind of like what prior handles were. So here we can see this narrows down to about 9%. And even back when the stock was at like 6%, if you look at these prior consolidations, that's about 9% there. This little choppy area, about 10%. So the price isn't going like crazy or anything. And why I bring that up is because near market tops, things often get more crazy and you're going to have bigger moves, and that signals more of a topping pattern. So if this was a really nice one because it was a little bit smaller, about 7%. So this indicated price still had potentially some upside. We weren't in a topping type scenario. But once you start to get these really wide ranging swings like we had up here, 20%, that's more of a danger signal that the price could potentially drop because bulls and bears, buyers and sellers are really fighting it out. Whereas here, it's like they're more uncertain, and then if we get the upside breakout, we know who's winning the battle. But when they're really fighting it out, and that's, not the situation I want to be in. So when you have really wide ranges compared to what we had before, that's a warning sign. But if they're about the same size as what we've had prior, that's a good thing. So here, not that I see any other cup and handles exactly, but you can just look at the consolidations because this is eventually contracting into a few day consolidation, and you can just look back on your chart. How big were the consolidations before? Oh, they were about 9%. 9%. About 8%. So they're still in the same ballpark. If we get a consolidation that's much bigger, then you may want to leave that one alone because your risk is starting to increase. And to get that 3-to-1 risk reward, if all these prior ones you're only risking 9%, but now you have to risk 20%, that price has to move up 60% in order for you to get your 3-to-1. Whereas if it's 7 or 8, 9%, that only has to move up, 15, 20, 30% in order for you to get the 3-to-1. So that's the general idea of cup and handle patterns. Just go back to our main summary here. And if you don't like the profit targets, you can also use a trailing stop loss. Just expand that out a little bit. And on TradingView, I like the ATR stops, but you can use moving average or anything that kind of suits your fancy. And this will catch the really big moves. It'll also help you collect little profits like this one. If it doesn't keep moving up, would stop you out eventually when the price moves below. The only problem with the ATR stops is I cater it to every single stock that I trade. I look through how it handled the last big swings to the upside. So here you can see it basically would have kept me in, and I don't just get out when it turns red. I wait for a close below the line. So in this case, we're going up. I'd wait for a close below this green bar, and then I put my stop loss below the low of that closing candle. So if we get a red bar that closes below this, whatever the low of the day is, I put my stop loss just below that low. So that's how I use this indicator, but you can use it as however you want. You can use it if the price touches it. That's going to stop you out a little more often, but it'll also maybe save you some money here. Like in this case, if you had been in this rally, price comes and touches the bar here, you could have got out. Whereas with my method, I would have waited for the close below, which didn't happen until this bar. Then my stop loss would have gone just below. I would have been getting out down here as opposed to up here. Other times, waiting for my method, waiting for the close will save you because the price will drop a little bit below and then keep running. There is no perfect solution in trading. There's always a trade-off. So it's whatever method you're comfortable with. So you could use the trailing stop loss. I think the easiest way is just a 3-to-1, 4-to-1, 5-to-1, depending on the strength of the stock. You can look at prior swings to determine how far the price could run. So in this case, 30% was pretty conservative, considering the price had run about 50% out of this last little consolidation breakout. Out of this one, it had ran about 70%. If you don't want to hold through these pullbacks, then just measure to the last pullback. So I was looking at about 50 to 60%. So 30% was a conservative target on that one. Yeah, and that's how you trade cup and handle patterns. So I hope that helps you out. There's also a cup and handle article on tradethatswing.com. I'll throw a link in the write-up below this video, so you can check that out as well. And until next time, happy trading.